Welcome to the Deep Dive, and specifically our TalkTickers segment.
Hey there.
We're here to cut through the noise on earnings calls. Today it's RLI Corp, second quarter 2025. They always seem to have an interesting story.
They really do. A bit different from the past.
Yeah, exactly. So we've looked at what the management team, Craig Clements, Jen Klopnock, Todd Bryant, Aaron Defantala had to say. Our goal today, find those key insights, those aha moments that show how RLI stays profitable, especially when things get choppy.
It's definitely a fascinating case study. So looking at the headline numbers for Q2, operating earnings came in at 84 cents per share.
Okay.
And what jumps out right away is investment income, up a strong 16%.
16%.
Yeah. Now, the overall gross premium growth, that was pretty flat for the quarter. But, don't let that figure mislead you.
Right. Flat growth can sometimes make you wonder, especially now. So what's really going on behind that number? What's it telling us about RLI?
It tells us quite a bit, actually, because despite that flat top line, they achieved an underwriting profit. And not just overall, but across all their segments.
All segments, okay.
Yeah. They posted a total combined ratio of 84.5.
So remind us quickly, combined ratio.
Right. It's your losses plus your expenses, all divided by the premium you've earned. Anything under 100% means you're making money directly from underwriting.
Got it. Profit.
Exactly. So 84.5, that's a very strong result. It is up a bit from 81.5 last year, but still, it shows really solid underwriting discipline.
Okay.
And beyond that, GAAP and net earnings, they hit $1.34 per share. That's a huge jump from 89 cents in Q2 last year.
What drove that big increase?
Well, a good chunk of it, about $44 million, came from unrealized gains in their equity portfolio. Investments doing well.
Makes sense.
And here's something really telling. Year to date, their book value per share, it's grown 16%. Impressive. And that's including dividends paid out.
Wow, 16% book value growth. That speaks volumes, doesn't it? About consistency and, long-term value.
Absolutely. It shows financial strength and that management knows how to build value over time.
Okay, so let's unpack the philosophy here, because that 84.5 combined ratio, that doesn't just happen by accident.
No, it doesn't.
RLI's management, they always talk about the long term. Discipline, continuous improvement, sustainability. It's their mantra. Almost.
It really is.
And they're pretty open about adjusting things as the market shifts, like taking significant rate hikes on things like wheels-based exposure.
Commercial auto, things like that.
Right. Or even just deciding not to compete in certain property markets if the risk versus reward doesn't add up for them. Yeah. Seems very clear. Profit and long-term value come way before just chasing short-term growth or market share.
And what's really unique here, I think, is how explicit they are about it. They have no top-line goals.
Yeah.
None.
No targets for premium growth.
Nope. Or even for the mix between property, surety, and casualty. The mix they end up with is purely based on where they see the best relative opportunities at that time.
So they'll actually shrink if they need to.
Absolutely. If the terms and conditions out there don't look like they'll lead to an underwriting profit, they'll pull back. They're willing to shrink.
That takes discipline.
It really does.
Yeah.
In a volatile market, that flexibility, that willingness to walk away from bad business, that's a huge advantage. It's pretty rare.
Okay, so that discipline clearly helps their underwriting income. You mentioned growth in earned premium. That's the premium they actually count as revenue, right?
Correct. Earned during the quarter.
And strong results from current claims. But you also mentioned favorable development on prior year's reserves. Can you break that down for us? What does that mean?
Yeah, good question. Favorable development. Mm-hmm. It basically means they'd set aside money in previous years for claims they expected to pay out.
Okay.
But it turns out those claims actually cost less than they originally estimated. So they get to release some of that money, that capital, back into earnings this quarter.
So it boosts the current results.
Exactly. And it's, a good side about their reserving. They tend to be conservative, setting aside enough, maybe even a bit more than needed. Better to be pleasantly surprised later.
Prudent. Okay, so disciplined underwriting, careful reserving. But you noted expense ratios went up in property and surety. Why? Should we be concerned?
It's definitely something to look at.
Yeah.
But management explained it's not about inefficiency creeping in. It's more about strategic investments.
Investments in what?
Things like technology, improving the digital experience for agents and customers, and investing in their people. Necessary stuff for the future.
Okay.
Plus, they also bought more reinsurance. That's insurance for themselves, basically.
Right, to cover really big losses.
Exactly. They bought more limit for their co-participations and their CAT treaty. That costs money up front, increasing net expenses, but it strengthens their balance sheet long term. It's about building capacity and resilience.
Makes sense. Strategic spending, not just uncontrolled costs.
That's the idea.
And speaking of strong foundations, what about the investment side? You mentioned the income boost earlier.
Yeah, investments were really solid. Operating cash flow for Q2 hit $175 million. That's up $33 million from last year.
Nice jump.
Definitely provides a good base. And it helped their portfolio return a positive 2.9% for the quarter. That caps off a really strong first half of the year on the investment front.
And the new money they put to work.
The average yield on new investments was 4.7%. That's a healthy 70 basis points higher than the yield on their existing portfolio. So they're locking in better returns.
Okay, good stuff there. Now, okay, let's dig into the property segment. This is where things get really interesting, right? Where that discipline gets tested.
Absolutely. Because gross premiums there actually declined by 10%.
10% down. Why?
Mainly rate decreases. Win rates, for example, were down 13% compared to last year.
Ouch. Competition.
Big time. Management mentioned something like 20 new entrants into the E&S property space. That's excess and surplus the market for harder to place risks. So you've got all this new capacity flooding in over the last couple of years, and inevitably that leads to, well, less disciplined pricing from some players.
So how did RLI react? Did they chase it down?
Nope. This is exactly where their philosophy kicks in, their response. Reduce exposure significantly. It's down 10% just from the end of last year, heading into hurricane season.
Walking the talk.
Exactly. They're only writing business where the rates are still above their internal benchmarks and where the terms are acceptable. If not, they pass.
Even in other areas like earthquake.
Yeah, the earthquake market is tough too. Submissions were down 7%, rates down 9%. They're seeing more small businesses in California just choosing to self-insure instead. But here's the payoff for that discipline. Despite the premium drop in market pressure, the property segment still posted a fantastic 62 combined ratio.
62? That's incredibly profitable.
It is. And it was helped by $10 million in that favorable prior year reserve development we talked about, including $5 million related to Hurricane Helen, where losses came in lower than expected.
Proof that walking away can pay off.
Precisely.
But they didn't pull back everywhere in property, did they?
No, not entirely. Marine premium was actually up 2%, driven by inland marine, even with competition heating up in ocean cargo.
Okay.
And here's a really interesting spot. Hawaii homeowners. Premium there surged 35%.
35%? How?
They got a 16% rate increase, but they also picked up business rolling over from other insurers who pulled back after the Maui wildfires. Classic RLI opportunism, finding pockets where the terms make sense.
Agile. Okay, what about casualty and surety?
Both saw solid growth, about 7% premium growth each. Casualty came in at a 96.5 combined ratio.
Still profitable, but closer to 100.
Right. It benefited from $15.5 million of favorable prior year development across several lines: general liability, excess liability, personal umbrella.
Okay.
But that was partly offset by a slightly higher underlying loss ratio in the current year, plus about $1.5 million in Q2 catastrophe losses from some package policies.
And within casualty, you mentioned personal umbrella earlier.
Yeah, that was a real standout. Grew 24%, and they got a 9% rate increase.
Strong.
Very. Though they did note new business counts have slowed down a bit in some places because they've increased the required underlying insurance limits and shifted their geographic focus somewhat. Smart adjustments.
And E&S casualty.
Also strong growth there. Top line up 13%. And submissions, that's applications for insurance, were up over 20%. So good demand, but again, you can bet they're being selective.
It sounds like controlled growth.
That's the theme.
Yeah.
Especially on those wheels-based exposures we discussed. Commercial auto, transportation.
Right. How are things looking there? They took some big reserve actions late last year.
Yeah, and management confirmed those actions taken back in Q4 2024 seemed to be sufficient. That's good news, you know. It means they likely reserved enough for expected claims.
Yeah.
But they're still approaching those tougher coverages very carefully. Getting rate increases, tightening underwriting. Rates in their transportation division were up 12%, even with lots of competition.
12% rate in a competitive market.
Tells you they're serious about profitability. They're using their in-house loss control team to help clients improve safety too. And across their whole portfolio, auto coverage rates were up 14% in Q2. Discipline in action.
Okay, and quickly on surety.
Surety posted an 87.9 combined ratio. Growth was mainly from commercial surety. Contract surety, which had been growing fast, moderated a bit.
And reinsurance.
They renewed their treaty back in April and again bought more limit to support bigger bonding needs for their clients. Another strategic investment.
Got it. Anything else on surety?
Management just emphasized they're constantly reviewing credit quality, supporting their contractors. They're winning business with new bonding requirements, marketing, and digital tools that make things easier.
Okay.
Oh, and an interesting portfolio shift. They mentioned moving a bit away from older oil and gas-related bonds towards newer stuff like solar farm projects, adapting to the economy.
Interesting. What about broader market trends? Did they touch on things like legal system changes?
They did. Specifically, court reforms in places like Florida, Georgia, Louisiana. It's still early days, especially for Georgia and Louisiana, to see actual changes in loss data. But it's already changing how underwriters think about those states. They're becoming a bit more willing to write business there again, even before the numbers fully prove out the reforms. Perception is shifting.
And Florida, any more concrete signs there?
Yeah, in Florida, they are seeing anecdotal benefits from tort reform filtering into claims handling. It's leading to some rate reductions, or at least less need for big increases. And this tied into a broader point they made about third-party litigation financing.
Where outside groups fund lawsuits.
Exactly. RLI sees more transparency and disclosure around that as really crucial. They want to know who's actually funding the other side, arguing it can artificially inflate costs and ultimately premiums. It's a structural issue they're pushing on.
Got it. One last check the construction market. Any worries there?
Doesn't sound like it. They said construction looks healthy in most areas. They're actually seeing double-digit increases in submissions for construction risks. No major red flags for them there right now.
Okay.
So overall, the picture is RLI sticking to its playbook. Cautious reserving, often booking more than the basic loss trend suggests, especially on auto. It all comes back to that consistent focus on profitability.
Okay, so let's bring it back. For you listening, whether you're an investor, maybe a business owner, or just curious about how successful companies tick, what's the key takeaway from RLI's quarter?
I think it's that their discipline isn't just talk. Their willingness to underwrite carefully, to strategically shrink when markets get irrational, that's the engine behind their consistent profit and financial health.
Right.
You see it in the strong book value growth, the solid investment income. They generate long-term value, even when the market's all over the place.
And those investments in tech and people?
Yeah, while they might nudge up the expense ratio now, they're clearly positioning RLI for the future. Efficiency, better service, sustained growth. It really is a blueprint for long-term thinking.
All right, time for our slightly different segment. This is not financial advice, where we pitch a trade idea, maybe a bit out there, like we're analysts talking to the investment committee.
Okay, committee, listen up. My pitch today is what I'm calling a disciplined arbitrage pair trade. We're focusing on that tough commercial auto liability market.
Discipline arbitrage, okay.
So RLI couldn't be clearer. They're taking significant rate, being more selective on wheels-based stuff. Why? Legal system abuse, double-digit loss costs, they will walk away. They even called out some MGA competition, those managing general agents, saying they have to feel the pain eventually.
So the trade setup.
Simple. Go on RLI. You're betting their strict underwriting pays off over the long haul. At the same time, you short. Well, you find a publicly traded MGA or maybe another commercial auto insurer that seems much more focused on just growing premiums fast, maybe looking less disciplined on rates and terms right now in this same tricky segment.
So betting on RLI's patience versus maybe market exuberance elsewhere.
Exactly. The thesis is RLI's discipline shields them from the nasty surprises that adverse development, those unexpected claims costs later on that are probably going to hit the less careful players. It's a bet on rigorous risk selection winning out over just chasing growth. Long RLI, short the potentially less disciplined competitor.
Got it. A bet on the long game. Okay, wrapping things up then. RLI's Q2 really underscores a company delivering strong results through, well, discipline and being adaptable. They put long-term profit and value first, consistently.
Yeah, this deep dive really shows how focusing on doing things right, maybe differently, and prioritizing that long view can work, even when the market's tough and competitors are piling in. It's about strategic patience.
So, for you, our listener, here's something to think about. Look at your own portfolio, the companies you follow or invest in. Which ones are really prioritizing profitability and long-term value over just hitting quarterly growth numbers, especially when markets soften? Are they willing to walk away like RLI does, or are they maybe getting caught up in that growth at all costs mindset? It's a critical question to ask.
It really is.
And just a reminder, of course, This is all for informational purposes. It's definitely not financial advice. Please do your own homework and talk to a financial professional.